Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist, Phil Putney. Now let's get rolling with today's show. Welcome into the final episode of Phil's Tax Hacks and Other Retirement Facts for the year of 2023. That's weird. We're going to be in 2024.
Yeah.
It's
hard to
goofy,
believe we're there
man.
already. So
I know. This is our last episode, last podcast for the year. We're going to do Santa's naughty or nice list. We'll have a little fun with this with some, I guess, some various products here is what we're going to do. Phil, I'm going to toss them out at you, and you would say, yeah, Santa probably put that on the nice list.
The nice list,
put that on the naughty list.
Yeah.
That's the idea. Yeah. And then we'll be back with new episodes starting in January. But that week between Phil and I were just joking, that week between Christmas and New Year's is like a dead zone. So it's like, everybody relax, recharge, get set for the new year, all that good stuff, right? And whatever's going to come our way in 24, which probably going to be a wild ride.
It's going to be a wild year. Yep,
yes.
I would predict. So
all across the board.
I'm a prognosticator. Or is that
prognosticator? There you go.
Yeah. But I think it's going to have some interesting twists and turns. So
yeah. Election year.
Election years always do. They present themselves very different. Yeah.
Economy, inflation,
there's
housing market.
A lot of things that are kind of, still in the balances and working their way through the system. So
it's going to be a little choppy.
Yep.
We're going to go with choppy.
So you better have a good advisor to help kind of walk you through that process.
That's true. That's true.
You're good. We're still on track.
That's true. You know what? We should totally, we'll revisit that later on.
Yeah.
And maybe we'll pull this up later on next year and see how close we are. Like if I'm sitting here saying, it's going to be choppy and I'm making faces. And then next year winds up being like
it's a stellar year or something,
right? Then we can be like, all right, you stink,
That's right.
So
my magic 8-ball, it was broke.
It really is, man. It's sitting over there. I had to throw it away. It was leaking. All right. Well, let's do Santa's naughty or nice list here, Phil. A fiduciary, I'm going to just a softball. Come on.
Yeah,
a fiduciary advisor.
Start out easy.
Very easy. Is this on Santa's naughty or nice list?
I would say it's probably got to be on the nice list, right? So, fiduciary advisor, that just means an advisor that puts your interest first. So, which most people are probably thinking, well, doesn't every advisor do that?
Duh.
Yeah. It's like, well, not really. And we've had plenty of shows on that to understand the pros and cons and differences, how they work. But just understand how they're licensed and what their responsibility is to you. Let's put it
and
that
many
way.
licenses and designations come with the fiduciary responsibility.
Correct.
So they're suitable. We've talked about it before. They're suitable, and there's a fiduciary.
And they're fiduciary, right?
Most advisors are probably going to be fiduciaries. Most financial planners are probabably going to be. And
that's the key. Most financial planners, and that's always the concern, or I guess confusion in the industry for. Just an individual looking for an advisor, quote unquote, is
right.
An insurance only advisor. Nothing wrong with that person. That's they fit
but they're not a fiduciary
person. A certain scenario, but they're not a fiduciary, right? Because they sell a single product. It's insurance, and insurance is a product that's needed.
Yep.
But it's not it doesn't fit every scenario, right? So they can't give you unbiased advice because everything to them, if they're a hammer, everything to them looks like a nail. So
I've yet to figure out how to make the Tommy Boy scene when he's trying to figure out how to explain that their brakes are better than the other guy's brakes.
Why would somebody put a guarantee on a box? Very interesting.
But that's, it's kind of like, do you want to trust the guy just saying these are the best brakes, or do you want to go with the actual best brakes? Was kind of the simplistic form.
Right.
And it's the same kind of thing with this setup here is there's suitable and there's fiduciary. And so you could go to a person who's suitability only, and they could say, here's 3 products. All 3 are technically good enough.
Right.
But I like this one because it pays me more, or because
maybe
it pays me more.
Right. There's a trip that, hey, if I sell this, the company has a deal going on where you get to go on a trip or whatever it is. I mean,
they're still doing their job.
Right.
And
it's suitable.
It's suitable. Right. But the fiduciary has to look at those same 3 and go, no, this one is the best one. And here's why.
Right.
And they have to back that up, legally, ethically, all that kind of stuff. Right. So it's just,
So the fiduciary follows suitability. It still has to be suitable. But I always say it's a step beyond that, right? So now it's suitable. Here's the 3 that are suitable. well, out of the three, which one fits your scenario best? Not taking our view of it out. Doesn't matter to me, and that's why typically, and from a license standpoint, the fee-based or fee-only are the fiduciaries, because to them, they're product agnostic. It doesn't really matter. Their
exactly.
compensation is the same no matter what they recommend. So
I like
so
that product agnostic.
that bias doesn't get, which is just natural, right? As a human, you get biased.
We all have biases.
Yeah, it's just how it works. So
if you say you don't, you're full of it.
That's right.
Product agnostic.
Agnostic.
That's
there you go.
That should be the tagline there.
Instead of fiduciary, and product agnostic.
Yeah, right. There you go. A variable annuity. Where's that at on Santa's list?
I would have to put it on the naughty list. So, so let's go back to my history. I've sold plenty of variable annuities back in the day.
Sure.
Back in the wild west of the 2000, right after the 2008 financial crisis. I mean, they were relatively new then, and they were coming out with a brand new product every 6 months, it seemed like, or 3 months. It was just crazy with the evolution of that product. And early on, I think they had some more benefits, but they changed dramatically over time. Biggest concern, is understanding the fee structure and how that fee structure works. Because
why is it on Santa's naughty list, right? Typically, it's that one, right?
Well, and again, I'm kind of throwing variable annuity as a broad product, right? So I'm throwing the variable annuity that has the income riders and is very fee heavy. Those products typically can range from, call it 3 to 4% in a fee. So, excuse me. So now I'm losing my voice. So,
yeah, I know, right?
But I mean,
we got frogs jumping around.
That's right. It's just understand how they work, right? Is what I can say.
Yeah.
And
and that's the thing, right?
So
if you're like, hey, I'm getting 7% on this annuity, but you're getting charged 5%, well, then you're not getting 7%.
And the other side of that, so I'm getting 7%, but 7% on what? Right. Oh, well, that's the income value. Well, the income value is never a value you can get. So it's only used to determine your income at some point. If you turn on guaranteed lifetime income, what the product earns is the investment side. And there's two different values often in these products and how they work. Right. So, I mean, again, it's very complex. Sometimes they don't get explained correctly, or even if they do, again, we're biased. Humans are biased. So you're listening to this spiel and you hear 7% guaranteed. You're thinking, oh, I'm earning 7% guaranteed, but you're not on the actual account value. It probably is on that income value. And understand, well, then what does that mean? So, anyways,
it's like when you hear like the free vacation stay if you go do this other vacation stay, and it's like, what's the catch?
That's
and
right.
It's like, you got to sit through the seminar,
and go through a high, pressure sales pitch and all the others.
But then you're looking at the really fancy, like the top end, vacation that's coming after it, and that's where your mind stayed, right? Versus hearing the other parts of it. So the bias can't creep in. That's just,
I mean, I would throw it on the naughty list because of fees and complexity, and just because of those, it's very misunderstood in how they work.
True. Fair enough. Crypto.
Oh, crypto. Yes. Yeah.
Crypto,
so I put this kind of in the naughty nice. It really depends. I mean,
it can jump throughout the day. Which one?
Well, and the reason I say that is this: it's an investment product, right? Nothing wrong with crypto. Understand what it is, though. It's not a get rich quick scheme. If you jump into it like that, you're gonna lose your shirt. So understand what it is, how it works. Like it or not, it's where we're heading. It's going to be part of the everyday norm as this world and this financial industry evolves. So personally, I invest in it, but it's something that I do just for my own to understand how it works, and don't have clients specifically investing in it, but I know enough to talk with clients about how it works. We do have some managers if you're interested in looking at that. But be very careful when you're looking at crypto, because it is right now it's the wild west out there in the crypto world. I liken it to the early days of the tech bubble, right? Where you had all these companies coming up with kids in their garage with this idea. They didn't even have a product or anything going yet, but they were raising millions of dollars and IPOs because they had this idea, right? So that's what's going on in the crypto world. There's all these crazy things going on. People are making money. People are losing tons of money too. Right. Out of this whole thing, there's going to come an evolution of some good crypto, you call them products or whatever, but currencies is how they kind of get referred to now, but it's not really a currency.
Right.
But cryptos that are going to come out of this years down the road. So
true. Yeah. And a lot of times, again, for our base, demographic, who,
way
it's
beyond
more
the
likely
risk level.
it's maybe, heavy on the risk side for you if you're closer to retirement. Right. So maybe a little speculative for fun, but be careful. So we'll put that in the, Santa might just leave it. He might just leave it out.
Yeah, and not even put it on naughty. There's nothing naughty or nice about it. It's just understand what it is. Because it's
just in the middle. Yeah. An HSA. I know where you're going.
HSA. That's going to be on the nice list. So especially, pre-retirement, building up to retirement, because, and we've talked many times on HSAs. I think there's one, even like a 2-show series on the HSA, but
go check that out. We got like a 2-parter.
It's huge benefits. It's the only investment vehicle out there that gives you tax benefit both sides of going into it. You get a tax deduction when the money comes out. It's tax free on the way out if it's used for medical. There's no other product from a tax standpoint that works that way. So take advantage of that, right? So if you're in a high deductible plan, make sure you're using it. Take advantage of that, save. And typically our process in that recommendation is you want to put the money in, don't take it out, use it for, think of it almost like a retirement medical savings account, health savings account for retirement, IRA for medical, if you want to think of it that way.
Yeah. We've talked, you've heard it talked about like a Roth on steroids. Yep. I mean, So lots of pros to the HSA. So put it in
the nice list.
Put it on the nice list.
So.
Yeah, exactly. Put me on the naughty
list.
All right. Let's see. Time-wise, let's see what we got going on here. Let's jump around a little bit. All right. Well, since we did a variable annuity and it was on the naughty list, what about an indexed annuity?
So indexed annuity, again, I'm going to put it in kind of that middle ground. I mean, there's, again, they can be somewhat complex because they'll have that income value and account value, some of them. Some of them don't. They use everything based on the account value. But typically, they're going to be more efficient from a fee standpoint, right? So you're not going to have as high of fees. Now, granted, again, you got to understand the products and how they work, because even though it doesn't quote unquote have a fee, they're still getting paid behind the scenes, so to speak, the insurance company is. So just understand how they work. Any insurance product is just by nature complex, so that's my my only concern with any of them is understand what you're buying truly, how it works. And if your advisor isn't going through a clear explanation of how this works, then maybe get a second opinion before you jump into it, because maybe they don't know, or they're not giving you all the information, or you're not hearing it all. It's always good to hear it again a second time, because you're going to overwhelmed, especially on these as you get into them, because there's so many moving parts.
Yeah, because there's so many wrinkles and stuff.
They can be a great vehicle if you're looking for protection, asset protection. One of the biggest advantages, you're with a index annuity, you're not going to lose principal to the market. Now, that being said, they're not typically growth orientated, right? So, I mean, it's not going to be a high growth type of investment. Another good use scenario could be if you're looking for some kind of guaranteed income. So those are two typical scenarios that an indexed annuity might apply to. But
okay. All right. Well, since we're in the insurance product world, long-term care insurance, would Santa put that on the nice or not?
I'll put it on. Santa would put it on. I'll say Santa here would put it on the nice list. So
you got the gray.
Put the Santa. I should put the Santa hat on today.
Put the beard on.
I would say put it on the nice list, and I'll tweak it just a little bit. I would say have long-term care discussion, which may lead to the insurance, right? So again, understand what it is. It's
the naughty side being it's expensive.
It can be expensive, right? And
okay,
you don't become insurance poor. You can buy so much insurance that you don't have enough then to live retirement, which, that's not a good scenario either.
Okay.
Right?
Okay.
But understand, don't then ignore the whole discussion around long-term care, because the reality is it's becoming more and more prevalent as you age, we're living longer. The side of that scenario that they haven't quite figured out yet is the brain and how, from a cognitive standpoint, to make the brain live longer too. So, I mean, there's dementia is very, very common, and that's where it gets really expensive in long-term care. So have the discussion. I mean, if it happens, what does it look like financially and usually the scenario there is to a surviving spouse, right? So the first person to need care,
Gotcha.
are they going to consume too much of the assets to where now you're putting that surviving spouse in a financial crisis for their later stages of retirement?
Yeah, well, definitely long-term care discussion should certainly be on
Yes.
the nice list. Wow. Okay. Let's go with something old school. I feel like the Monopoly guy.
All right.
The little
Yeah,
cards
oh
and
yeah, we
the
play
dividend
Monopoly
stocks.
usually
What was
every
that like?
Christmas. So
Yeah, you've received
bank dividend,
bank error on your. No, it was not bank error, but it was dividend stock something. Yeah, there you go. What do you think about dividend stocks?
I put it. I say the naughty list, and let me explain because I'm going to get a lot of hate from this, I'm sure.
Okay.
And the reason I'm going to say the naughty list is I think most people that are invest in dividend stocks look at it the wrong way, because they only focus on dividends, which, granted, dividend stocks are great in that they pay dividends. But the reality is, any investment, you have to look at it as a total, what do we call total return, right? There's two aspects of return. There's the income side of it, that's the dividend. But then there's the investment side of it too. And if you invest, especially again, our demographic for retirement in dividend-based stocks, well, it can be paying a dividend, but if the value, you seeing your statement value drop by 30, 40, 50%, are you comfortable with that? Are you going to be able to hang on if that happens? So understand both aspects of it. And the reality is with that is that if that's going on, meaning usually that means we're in some kind of a recession or downturn in a market, what's happening to the dividend? Historically, as that happens, companies do cut dividends. So again, just understand, it's almost like the annuities. Understand what it is. Don't just look at the one side, oh, the dividends, I want the dividends. Okay, that's great. There's a company behind that dividend, though, that, what's their financials look like long term. And just make sure you understand, go into it eyes wide open, both sides of that equation. Because often I think it gets misrepresented or misplaced because of that, because people are like, well, we're going to have a dividend portfolio and, it's average, whatever,
right. Heavy dividends,
which is awesome. Yeah. Not guaranteed. If as things happen, companies do cut dividends, number one. Secondly, is it's going to have some volatility because at the end of the day, it's still a stock. So.
Right. Yeah. Okay. All right. So time wise, we're getting a little long here, so we'll jump around a little bit more. See, we'll do a couple more. Roth IRA, Santa.
Yeah, that's got to be on the nice
that?
list. So,
okay.
Yeah,
right. That one's pretty easy.
Understand the Roth. Make sure you build it into the plan. But again, like anything, it can be like the Christmas cookies, right? It's on the nice list, but you can overconsume that Christmas cookies. So, same thing here. Make sure you know where it fits. Don't put everything into a Roth IRA, because then it might not be quite appropriate in your scenario. But it
okay. Don't overstuff on the Christmas cookie. Don't overstuff on the Roth. Maybe
have the right blend in your overall scenario,
like
your tax buckets. So.
Yep. I like it. Okay. Risk assessment score. Okay. So I talk to advisors all across the country. Some love it. Some think it's the greatest thing since sliced bread. They absolutely think you should do it and keep up with it. And they use that heavily. And others think it's just a waste of time. What's your thoughts on
I put it on the nice score? I put it on the nice list. And the reason is this. I mean, it depends on what you're using it for. If it's the only thing you look at, right? If you say, well, your risk assessment puts you at a moderately aggressive portfolio, so here's what your scenario is. So everything goes into moderately aggressive, which is more volatile, and that's what they're comfortable with. But yet this client is now in retirement. Well, even though they're comfortable with that, and usually risk assessments that's kind of their focus, right? What is your comfort level? Well, now, because of sequence of returns risk, you actually might not have done what I would call the right thing for that client, because now you've put them at a higher level of risk than what is appropriate for their scenario. So again, just understand, it's key. We use it with clients. And as an advisor, we have to, right? It's an important aspect to understand. What is your comfort level? you don't want to go into a scenario saying, oh yeah, I'm comfortable with risk. And then you get there and the market's down 20, 30%. And you're like, oh, get me out. I can't do this. Well, we need to know that ahead of time. So that's where we look at the risk tolerance is more from that drawdown and that volatility. What's your comfort level? How are you going to react if you get a statement over 2, 3, 4 months and this happens? If you're saying, hey, I understand that I'm long-term focused and I'm comfortable with that. Okay. Then if we're doing that for our clients, well, that's probably going to be in a later bucket. It's a more risky type investment because now we have time to ride through that volatility and it's not going to harm them.
So it can be a helpful identifier, but not necessarily. It shouldn't be Rudolph's nose.
It shouldn't be the only thing that your advisor's looking at there. That's a good analogy. Your advisor's only looking at that risk tolerance and saying, "Oh, well, you said you're moderately aggressive, so here it is. It's on everything you have." Right?
Right.
Probably is going to get the wrong result for that client in the long run. So,
okay. But risk assessment score, that 3 times fast. Risk assessment score could certainly be
absolutely helpful.
So there you go. Yeah. All right. Well, that's Santa's naughty and nice list. We'll wrap it up this week here. We'll get out of here and let you guys enjoy your holiday season. Phil, I hope you and the family and all of our viewers and listeners have a great holiday season. Enjoy themselves. And we'll be back in January with some new episodes right here on Phil's Tax Hacks and other retirement facts. Don't forget to subscribe on Apple, Google, Spotify. Google's all now YouTube. So go to YouTube thing and subscribe. We've got little shorts on there and we've got the full videos and you can subscribe that way. So lots of stuff out there for additional content from Phil. And you can find it all at philstaxhacks.com. That's philstaxhacks.com.
Right.
Buddy, I'll see you next year.
Merry Christmas and a Happy New Year. We'll see you after the first of the year, 2024.
Phil?
Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.